Good morning and welcome to the live series Straight Off the Bat. Join us on Thursdays as we speak to individuals across multiple industries who will help you understand financial literacy and education. If you join us from Facebook, thank you so much. Don't forget to like and follow our page to continue seeing content that will help you manage your money. I'm your host, Pauline Joseph, and today we're discussing what you should know about auto loans. Our guest today is Shaun Sookdeo. He's the manager of the Auto Financing Department, the external sales unit at Scotiabank Trinidad Tobago Limited. He holds a master's in business administration and has 20 years banking experience. And outside of the bank, he's also an international umpire in the sport of badminton, having officiated at high level tournaments. So we want to welcome Shaun today. How are you?
Hi, good morning to everyone. Thank you for having me.
Great. So, as someone who has a discipline for sports, we are grateful that you're joining us today because we want to translate that into this loans conversation, which seems to be quite a popular one based on the comment section. So, let's start from the ground up. Let's start really basic. What is an auto loan?
So, usually I like to tell my customers that auto loan is the second biggest purchase that you're going to make in your life, maybe more than one situation. And essentially, it's the bank providing financial assistance in purchasing the car of your dreams, whether it be for work or for pleasure. And it's a process involved in terms of getting the vehicle that you like, color, type of vehicle, model, and so on, and the bank providing the assistance in terms of offering you a loan to finance that dream. Similar to a home purchase, the criteria is almost the same. Well, actually, it is the same when it comes to credit aspect of it. The difference being just the purpose of the loan.
All right. Thank you so much for that. And are there different types of auto loans or car loans?
Essentially, there are different car loans. To put simply, you have the car loans that you have for personal use. Those are what we call retail facilities where customers, such as you and I, who are interested in purchasing a vehicle for private use, family use. And also, we have auto loan facilities where you will have, such as companies, small businesses, who will be looking to purchase a vehicle for the purpose of using for their business. That's what we call business loans. And so that's essentially the two types of auto loans that we have. The criterias are different for both, and each one is looked at differently in terms of how the credit is assessed.
I want to find out a little bit more about that shift of business and personal because we've had on this live show some fantastic guests, which included the conversation around commingling funds. So
Mhm.
when it is you are applying for a loan, why is it important to understand those two differences?
So that's a very good question. And when it is that you're a business owner and you're looking to purchase an item, it's very important that you have your funds separated or funds passing through your business account as opposed to your personal account. The reason for that is you want to be able to accurately reflect what your revenue is, which will allow financial institutions to understand your business, understand how your business operates, the income earning capabilities of the business, which will help that company achieve whatever financial goals that they may have. Some companies may be looking to buy one or two vehicles to assist with their fleet, and having that information allows the financial institutions to help assess the credit and know what you can qualify for. So when you don't put all your business proceeds into your business account and you have the funds in different locations, it's very difficult to assess properly what the income or the revenue is for that business.
Thank you so much for that. I think that's advice I wish I knew like 10 years ago, but better late than never.
Mhm.
So, when it comes to, um, you know, the financial space, let's be honest, there's some trust issues. So,
Mhm.
why would someone choose up to, instead of paying for a vehicle full in cash, what are the benefits to take out this auto loan instead?
So that's a very good question. And a lot of people do ask the question, why don't I just pay for a vehicle in cash as opposed to taking a loan? Now, depending on your financial situation, each person is different. And some may be able to pay for a vehicle in cash full with no problem. But what I usually advise customers is that at the end of the day, a vehicle is what we refer to as a depreciating asset. Unlike a property where the asset can the value can appreciate based on renovations and facelift painting and so on. A vehicle, the value of the vehicle depreciates. So essentially, when you take your cash savings and you purchase a vehicle or maybe two vehicles, as the case may be, you're using funds that you would have taken time to save. You put aside month over month, week over week, and it would have taken you time to accumulate that funds. In taking an auto loan as opposed to paying in cash, what you're effectively doing is that you are utilizing the proceeds of the loan to help purchase that vehicle. At the same time, you are keeping your cash in your savings account or fixed deposit wherever you may have it, which will allow you to actually, for want of a better word, have your cake and eat it too. In that, your cash will be available for you for any emergencies that you may have in the future. In this day and age, you really want to make sure that you balance your finances to be able to not only afford what you would like with vehicles, but properties and so on, but also have that nest egg available for any emergencies that you may have.
Yeah, and I just want people to know that if Beyonce can have a mortgage and have a loan, you too can, do that as well. So it's understanding the system. So
Yeah.
what we want to talk specifically, Sean, to Scotiabank and what criteria do, do you offer to determine eligibility for an auto loan?
So eligibility for an auto loan, not only with Scotiabank, but I believe all financial institutions would more or less follow the same format. But essentially, what we look at is the customer individually, and we look at a few things. The first thing we look at is we look at the customer's employment as well as their income. The reason for that, we will look at their employment in terms of how long the customer has been employed with their company. Um, if it is that they have been there for a long period of time, their income that they earn, whether it's paid, they are paid weekly, monthly, fortnightly. And the reason for this is that this speaks to the customer's capacity to pay for the facility. And so that is a very important factor when looking at an auto loan. The other thing that we look at, or what we use to help determine the eligibility for a customer, is their credit rating. And their credit rating is where we would look at your credit report. We look at your TransUnion report, which will show your past and current facilities and how you are repaying that. That speaks to the customer's maturity in terms of managing their debts and making sure that they are making their payments on time. So having an excellent credit report where you are paying your loans on time, paying your credit cards on time, works to your benefit because your higher credit rating, the higher probability or the ease you will be able to get a loan with any financial institution. Um, we also look at if the customer is going to be looking at injecting a down payment or if it is that they're looking at 100% financing. This will determine what your customers, what we call your debt service is. And I'll speak a bit on that. So debt service is the percentage of your gross income that goes towards paying all your existing credit facilities and whatever new, which includes the new facility that you are applying for. Um, with Scotiabank, your debt service ratio range can go from 35% all the way up to 50%, depending on the client. And that's why we do individual assessment. There's not a broad approach with all customers um, when it comes to your debt service ratio. Of course, we look at, as I mentioned before, the down payment. And if they're putting out a down payment or they're looking at 100% financing. Um, we also look at if it is that there's any additional collateral, if there's any assets that the customer is putting towards the application that will help strengthen the application. So essentially, what we're looking at from all of that I just explained is what we call the five C's of credit. So we're looking at the character of the customer, the capacity, the capital, collateral, which will be the vehicle, of course. And if there's any conditions or any stipulations, we may put forward to the customer that will, to tie everything together. Excuse me for that.
Um, so I'm
Are you
seeing
hearing me?
Donna's comment. We are. I'm seeing Donna's in the comment section, but Donna, I think you need to have a little bit more elaboration on some of your questions because I'm not clear when you just put the word bonds and question mark. I'm not sure what that means. And does the signature creates the credit? I'm not clear on that. So let us know what you're trying to get at. So Sean, you mentioned earlier about the cars and so forth. I want to tap back a little bit and find out how important it is to know about the car before you apply for the loan. What does the step look like when you are coming to the bank? Like, okay, I'm tired of of traveling. I want to be able to jump in a car and be able to have control of my time. What does that look like for the customer? Do they have to go find the car first, or do they have to go to the bank first?
Generally speaking, what happens is customers usually come to the bank and say, "Listen, I would like to purchase this particular vehicle," with not understanding, okay, is this something that I can afford? And do I need to put out a down payment and so on? So ideally, I usually recommend to customers to come to the bank or even visit our website and touch base with one of our auto finance specialists, um, who will assist in working through with the customer, looking at what their income is, what the existing debts that they may have, and, excuse me, advise in terms of what the customer can qualify for in terms of a loan amount. Just very important, because some more often than not, we have customers who will come with an invoice for a vehicle for, I'm just using an arbitrary figure here, 500,000, and really and truly that is not, they cannot afford to, based on the qualifying criterias, it's not within their qualifying range. So I usually encourage customers to visit or connect with one of the auto finance specialists, have that conversation, know what your qualifying range is, which will now help you in your search for a particular vehicle. The good thing about that as well is that based on the relationships that our auto finance specialists have with the various dealerships, they can also suggest not tell you what to purchase, but suggest what options are available to the customers so that they can go and look at the vehicle and look at the vehicle and see if that's something that they like. The other thing I usually encourage customers to do is that when you're looking for a vehicle, look at and selecting a vehicle, look at the vehicle in terms of what the purpose of the vehicle is for, what in terms of your personal life, your family life, um, and how does that vehicle fit into that dynamic. So you don't want to be purchasing a vehicle where, the size of the vehicle may or may not be ideal, or you may be looking for something bigger or smaller. So these are the things that I usually advise customers that they can look at when purchasing a vehicle.
That makes sense, especially when we're in a social media age and everybody's like hashtag living my dreams. But the reality is, what does that mean for your debt ratio, which you mentioned earlier, which we will
Yeah.
expand on. So we're gonna go on a quick break, and when we come back, we're gonna talk about those dream vehicles, and maybe we maybe need to tune it up a bit. So we'll be right back. And welcome back to Straight Off the Bat, a show that helps you understand financial literacy and education. Thank you so much for joining us today. And if you're doing so from YouTube, don't forget to subscribe to our page to continue seeing content that'll help you manage your money. Today, we're discussing what you should know about auto loans with Shaun Sookdeo from Scotiabank Trinidad Tobago. So we're gonna bring him back in because we only have another 45 minutes and there's so much more information to cover. If you have any questions, don't forget to slide into the comments and let us know. We will ensure to respond to it as soon as possible. So we would have mentioned, what exactly is an auto loan, the things that you need to know about and bring to the bank. But in terms of some of the common reasons, because we want to talk about, why not, a lot of us have these ideas of things that we want to be able to do, like, I don't know, have a pickup truck and go off roading. But when it comes to our finances, it may not necessarily mesh with our dreams. So, can you explain some of the common reasons auto loan applications may be denied?
So, auto loans, just like with any other facility, there are a number of reasons why they may be denied. One of the main reasons for an auto loan being denied would be the customer's credit rating. And when I speak about your customer's credit rating, I am referring to their credit report and the repayment history that they may have for their past facilities and even their current facilities. A lot of customers think that, I may not pay 2 or 3 months, but I may pay a lump sum at the end of the fifth month or so on, and then they may have some late payments in between, and then it's settled, and it'll be like, okay, well, I paid off the loan. What's the issue? The That really and truly is not helping the customers when it is when they're coming to purchase a facility. When banks look at your credit report, what they are looking at is, yes, we will look at if the loan has been paid off, but what we are also looking at is the customer's ability to manage their expenses on a monthly basis. And a lot of customers sometimes don't understand, particularly with credit cards as well, that it is important to ensure that you maintain your monthly commitments, whether it's a credit card, an auto loan, or mortgage, because this is reflected on your credit report. Your ability to manage your debts um, effectively on a monthly basis speaks to your, what I like to refer to as your financial maturity when it comes to your finances. This So when customers don't have this repayment history in an effective way, it sometimes impacts their it not sometimes sorry it impacts their ability to qualify for an auto loan. So that is very important. Another reason that we see customers unable to qualify for an auto loan is that they come to the bank and they're looking for 100% financing, but unfortunately, based on their income bracket, their their debt service ratio um, does not allow for that facility to be granted to them. They need to inject a down payment and also pay for the insurance and so on. So if you don't have that ability to put out your down payment, it unfortunately would lead to a customer not being able to qualify for the loan. And the final one I would say is if the customer has any bad debts or judgments against them, which also works. So if the customer has bad debts or judgments, unfortunately, we will not be able to approve a facility for that.
So, Sean, I want you to explain something that may be obvious to a lot of people, but I don't think we need to can't take for granted. Information might be out there, but we don't always understand certain things, and a lot of us don't want to seem stupid. But that's okay. I'm here for the people, guys. What is credit history? Because you mentioned it before. We've had it on the show mentioned in the past as well, but you can never say it too many times. What is credit history and how can you actually have that?
So credit history is actually a very good question about credit history, and what a lot of customers don't realize, and from speaking to customers personally, is that you have the power to manage your credit history, understand what your credit history entails based on the facilities that you have, simply by paying more attention to what is being done with your when you apply for loan. Now, to get a credit history, first and foremost, you need to have credit. It can be an unsecured loan, it can be a secured credit facility like a credit card on another loan, but this is how you build your credit. So usually, what will happen for customers to build your credit history, we recommend you start small. Some customers go big, to buy their first vehicle and so, which is fine. And based on the individual customers, you may be able to get to that high loan. But on a general basis, what you can look at doing is doing like unsecured facility, maybe a small loan where you will take your time and get accustomed to paying back your loan on a monthly basis, so get into the habit of that monthly commitment. Even a credit card, whether it's a secured credit card or an unsecured credit card, you apply for it, you use your card, and you make sure that you pay it back based on the payment cycle. My colleague would have spoke about this previously, but it's very credit cards is actually one of the ways that customers' credit history or credit rating is impacted, because we do the payment cycle is not understood properly, and the payments are being made on different days after the payment cycle, the payment is due, which impacts their credit rating. So, what I usually tell customers, first and foremost, by building your credit rating, you can start off with small credit like a credit card, unsecured loans. Get accustomed to making those payments monthly, making sure that you're managing it effectively, and this will help build your credit rating. In terms of managing your credit and understanding what the banks are seeing out there, I usually encourage customers to, when they have time, you can visit the credit bureau department in Trinidad. One company that banks use regularly is TransUnion, and this is something that is open to the public, in the sense that customers can visit TransUnion, they can visit and they can and see, and they will explain what the credit report for the has, what it means when you see a one, two, three, four, or five, as the case may be, on the report, and how it impacts the customer. And I usually encourage customers to do that, even if they're not looking at taking a loan, and they just want to know what is the banks are saying in terms of their repayment history and so on. They can reach out, and they can be guided accordingly.
Thank you for that. Can you mention, you said it's TransUnion?
TransUnion is one of the credit bureaus that the banks usually use when it comes to assessing and getting information in terms of customers' past and current credit facilities.
Okay, so guys, if you are in the comments, sign up for the next live show. And what we tend to do is follow up via email, sharing with you the information that Sean has shared today. We'll do our investigating ourselves, but I think all of us need to understand our credit report. I'm seeing a question coming from LinkedIn. Unfortunately, it's not going through um, the comment section, but I'll read it out for you, Sean. Hopefully, you will remember. So, Paulette wants to know, how do you account for assessing an auto loan where the customer is transitioning from employment to self employment, a lower income to a higher income?
Okay, so a customer transitioning from salaried or you know employment with another company, and they are going into a self-employed environment, it's a very, I don't want to say tricky, but it's one that customers need to understand, in terms of you are moving from a fixed income earning capability with being employed with a company, to one where your income varies month over month depending on the progress or the performance of the company. Now, what we usually look at in terms of the stability of a customer who is self-employed is how long the business has been in operation. Um, of course, we look at bank statements or financials or tax returns, based on what our policy requires for self-employed customers. But if a customer has just moved from a fixed income earning capabilities to self-employed, the key or the strength of that is really with the how long the business has been in operation. So, for example, a business that has been in operation for 10 years versus a company that just started 3 to 6 months ago, there's not there's not enough information to make an assessment in terms of what the income capabilities is for that self-employed customers. What we usually recommend for those customers is what we usually do is look at if the business has been in operation for at least minimum 2 years, and there's evidence to show stability with the income. What's the other part of the question? Sorry.
Um, it was assessing the auto loan where the customer is transitioning from employment to self-employment. I'm not sure where the low income to high income fits in.
Well,
Is that
it's in that case, it will work to the customer's benefit if their income their income was a lower income before and they moved to a higher income. What that just essentially means is that they're qualifying from the debt service mindset would be a positive. So the higher the income for the customer gives a bigger leeway in terms of their debt service range. For example, if a customer's salary is 10,000 and we're working with a 40% debt service ratio, that's 4,000 versus a customer's whose salary is 20,000 and we're working with a 40% debt service rate. So the capabilities there is going to be, it will vary.
all right? So Justin, I am going to come to your comments. We had some comments coming in from LinkedIn first, but we're going to answer your question right after this break. We'll be right back. And welcome back to Straight Off the Bat, a show that helps you understand financial literacy and education. Thank you so much for joining us today. And if you're doing so from LinkedIn, don't forget to subscribe to our page to continue seeing content that will help you manage your money. Today, we're discussing what you should know about auto loans with Shaun Sookdeo from Scotiabank Trinidad Tobago. So, before we went the break, we answered a question from LinkedIn. So, we're going to head over to Facebook. And Justin wants to know if you said, Sean, 35 to 50, 35 to 50%, that 50% for everyone or special people. Do not say that.
No, 50, again, it depends on the customer. It's not about special persons or we are trying to single out anybody in particular. It all depends on the customer and their overall profile in terms of income their income that is being utilized in the application. So a customer with for example, a $10,000 salary versus a customer with um, an income in excess of 20 or $30,000, their the range and what we look at their residual income as well as their overall profile in terms of their credit rating. So it depends on the customer as inclusive of all the information at hand, employment income, their credit rating, particularly their income, because that is an important factor in terms of the capacity of the to be able to manage the debts available, whether existing or the ones being applied for. Hello?
There we go. Can you hear me?
Yes, I can hear you now.
All right. So sorry about that. I have no control over this Wi-Fi situation. So we are live. That's proof that we are live, guys. All right. So I'm sure that you answered Justin's question because he said thanks in the comments. I missed it, but I will check it up on the replay just like you can as well. So we're still in the comment section, and Anne Marie has a very specific question. So let's hope Sean can assist you. What if you have existing loans and all mortgages are paid to date and want to get another loan, but you have maxed out your security, but your customer has a good credit history? Um, are you clear? Are you understanding this question?
So let me see. So if I'm getting this correctly, all your mortgages are paid up to date, and you want another loan. You've maxed out your security. Now, I'm not sure if you're referring to the security of the property, but usually when you're doing an auto loan, the vehicle will be used as security for the loan. So unless it is that you're looking to use your property or your mortgage property as the security, and you're maxed out in terms of your loan to value. In this case, if you're purchasing a vehicle, the vehicle will be held as security. The only issue at this point in time is with respect to your credit rating and your debt service ratio in terms of income versus expense, your monthly financial liabilities. Once it is within policy or within the criteria set out, you would be able to get through.
Okay,
I hope
thank
that
you so
answers the
much.
questions.
Yeah, well, really let us know in the comments if we answer that question, if we need to expand a bit. So let's shift over to the actual cause, because let's be honest, a lot of us consume media from the US and everywhere else. So we see these cars, we see certain sort type of models, which may not be accessible to us. So when it comes to eligibility for these auto loans, what do we have to be mindful of? What are the restrictions? Because Trinidad and Tobago is very unique in so many ways, and it includes what we can and can't do with auto loans.
So when you speak about eligibility, you're taking to just to make sure I understand, you're speaking about qualifying for the loan or in terms of the type of vehicles.
So I know there's certain age groups that you can get 100%
Okay.
financing, and then when you get a certain age, like for instance, my car in Trinidad is 20 plus years, so that's not going to be an option. So can you expand on what that looks like? Because you may have an idea of a car that you want to purchase, like a second-hand vehicle, for instance, because that's within your budget. But when it comes to financing, what's the criteria there? What's the restrictions?
So that's a very good question. When you're purchasing a new vehicle, we do offer 100% financing. As a matter of fact, most financial institutions would offer 100% financing based on the customer's profile and their credit rating. With Scotiabank, we do, if the customer does not qualify for 100% financing for a new vehicle, we can go as low as 5% down. Usually, you will find the standard being 10% or even more. Now, in instances where the down payment is more than 5%, it is usually because of the element that we've been speaking about before, which is your debt service ratio. So a higher equity injection, a higher down payment could assist, may be required for a customer to qualify for the vehicle that they are looking at purchasing. When it comes to used vehicles or roll on roll local used vehicles or roll on roll off vehicles, um, with Scotiabank, we finance those vehicles up to a maximum age of 6 years. In the terms of the vehicle can be up to 6 years old, and we can finance those vehicles as an auto loan. What will vary based on the age of the vehicle will be the term of the loan as well as the down payment, as opposed to a new vehicle. Reason for that, as we mentioned earlier, a vehicle is a depreciating asset. So when you look at that's way in 2024, but you're looking at to purchase a vehicle that maybe, let's say, 2020 year of manufacture or even at 2018, the value from then when the vehicle was first manufactured to now would have depreciated over time. So from a risk perspective, what we do is that we still finance the vehicles or still offer financing, but in terms of your down payment requirement, it may be higher, maybe a 10 or 15% or even 20% down payment, depending on the customer's overall profile and what is required for that facility.
Okay. So are there any in terms of likelihood to be denied if you go ahead and get local use versus a roll and roll off? Is there an ideal situation you need to be if you're looking for a used car?
So customers' choices when it comes to whether it's a local use or a roll and roll off vehicle, as I mentioned before, the maximum age that we will finance as an auto loan is up to 6 years. Now, as a customer can be they can have a very good deal in purchasing a local used or pre-owned vehicle. They may get a very good deal on a vehicle that they saw they like the condition of it and so on, versus a roll-on roll-off vehicle that they may be purchasing from a roll-on roll-off dealer, um, or even a new vehicle. One of the things I usually advise customers to bear in mind is what you are getting for the value of the vehicle. For example, when you purchase a brand new vehicle from, let's say, Massey Toyota, one of the conventional new car dealers, that vehicle will be coming with your warranty, full warranty, 3 years or 100,000 kilometers. Or in some instances, I see some of these dealers are offering higher warranties for the vehicle. Roll on, roll off, their warranty will be different or from what a new car warranty would be. But local used vehicles, if you're purchasing a local used vehicle, um, you are essentially purchasing that vehicle as is. You wouldn't get any warranty or any recourse if there's any issues with the vehicle. So while we'll be able to finance it, we will do valuation. We will do a valuation on the vehicle just to make sure the value is there, as well as the condition of the vehicle is in a good condition to hold as security um, for the loan. But apart from that, there's no warranty associated with it. So these are things that you have to take into consideration as well.
Okay, so this is all great information, guys. Don't worry, it will be available again on the replay. And we had Kieran from Scotia a couple weeks ago talking about mortgages and the fees associated with it. If you missed that, don't worry, we'll put the links in the comments. So I want to ask Sean, what, because you're like, okay, you see the cost of a car and you think, okay, this is the amount of money that I have to borrow, but in reality, there are fees attached to it. So can you break that down for us?
Sure. In purchasing with the purchase of a vehicle, there are a couple of fees that you have to pay. The first fee is the processing fee, which will be a percentage of the loan amount, not the cost of the vehicle. We have the credit report fee, which is the cost associated with accessing the credit report and the information in that report. Um, and finally, the third will be what we call the legal or the mortgage bill of sale fee or the legal fee. This legal fee is essentially because the bank will be holding the vehicle as security. There's a document called a mortgage bill of sale which has to be executed with one of our attorneys that is on our panel, which is which puts um, which simply puts that the vehicle is being held as security until the loan is paid off, right? Um, so those are the fees essentially associated with purchasing a vehicle. If it's a roll-on-roll-off vehicle or a local use, an additional fee associated with the evaluation, which is about $200 to $300, depending on the valuator that you use.
Okay, so important to know. And then there are also, I'm not sure, I mean, this is not within the bank space, but there's also the transfer fee from the government that you have to be aware of. All these things we need to take note because you don't want to be, surprised
Yeah.
by something that you did not plan for. Do you have any, just from a personal perspective, any advice on someone who is, getting their new car? What is one of the biggest unplanned things that you've seen?
And so you broke up there a bit. Could you repeat?
What's one of the biggest things that happens to car owners that may be unplanned that they should be mindful of?
So w- unplanned. So when you're purchasing a vehicle, a lot of things in terms of apart from the fees associated with the loan, as you mentioned, your customers should plan for and put in place for insurance. Unplanned things, I do knock on wood. I hope that customers don't usually have this, but you do. I do encourage customers to have a bit of funds put aside in the event of things like, for example, um, unforeseen circumstances when you're purchasing a vehicle, maybe tires. Your tires may get damaged and you may have to replace all, or you may get, you may have a situation where um, the battery may go in the vehicle. But in this, a lot of the vehicles now you have is hybrid vehicles. So you don't have much of that issue. I would say in terms of unplanned would be for like regular maintenance of the vehicle, especially if the vehicle is under warranty. Because most vehicles, when you purchase them, you have a warranty your package that you have to maintain. So that is a cost that you have to make sure and have money aside for that. But in terms of unplanned, there really isn't much apart from maybe if there's an issue with the tires, for example, which is a consumable. You may get the tire may be damaged by from the roads, or something may happen and you may have to change that immediately. So those are consumables when it comes to, and it's unfortunately not covered under regular warranty. So that is something that they will have to cover for. Unless it is, of course, some customers, they may want to also do some cosmetics on their new vehicles with ceramic coatings and so on. Usually, there isn't really much in terms of unplanned because the vehicle would be under warranty.
All right. Well, thank you for looking into your magic ball and giving us some insight there because you just never know. All right. So I want to find out from you how in terms of the approval process, how does it work and how long does it typically take from the application to approval? Because a lot of us, have plans to go to the beach. So we want to be able to drive there.
Okay, so the typical, firstly, let me start off with the typical process, or the length of time that the loan can take depends on depends on the customer and how quickly we can get the documentation. The process can take between 24 to 48 hours. If the customer is self-employed and it's going to take the customer a bit of time to get all the documentation in hand, or to accumulate the documentation, it may take a little longer. But it all depends on the customer and how quickly that they can get the information documented.
Are we all right? So it seems that we may have some technical issues. We want to go on a quick break. We'll be right back.
everywhere. I remember my first
Oh,
girlfriend I had, I was wearing that shirt. That was the style I was slamming. Wouldn't wear it now. That's when you used to wear big clothes and baggy jeans.
Right,
And
right.
I still have that shirt up to today. Hi, my name is Mark, and I am a banker. And this is Ask a Banker Anything with BATT. Doubles or roti, you could only choose one. Doubles all the way. Doubles for breakfast, lunch, and dinner. Working in the bank and being privy to the different levels of technology that we have and payment systems, I hardly have cash. I literally never have cash. And the day that a doubles man can have access to digital payments, I will never have cash. I use, whether it be cards, debit cards, online payments, online transfers on a regular basis. I cannot remember the last time I stepped into a utility company to pay a bill. Definitely I do everything in either online or digital space. How did you get into banking? Truth be told, purely by accident. I always say I had applied to several different institutions. When I left school, it just so happened that First Citizens, reached out, and I thought I was just going in to do a job, and little did I know that it would really jumpstart my entire career. If you weren't a banker, what do you think you would be? I know that offhand. If ever I decide to leave banking, I would definitely love to open up my own restaurant and be a chef that specializes in gourmet Creole cuisine. What's the first thing you would do if you checked a bank account and it had $1 billion in it? I would immediately call the branch and find out why that money is there. I am a God-fearing man, and they know that $1 billion would definitely not be mine. The first thing I ever purchased when I got my first paycheck was a blue plaid shirt in Detour stores. I remember watching the shirt for an entire month, and I told myself when I got paid, that is the first thing I'm going to buy. And so done. Why is having a bank account important? For many reasons. For you to really be part of this payment ecosystem, it all starts with for you to apply for a loan to fuel, whether it be a mortgage or a car or you want to take a loan to do some studies or personal, it starts with a bank account. A bank account is really the first step in cementing that relationship between you and the financial institution. So it really is the foundation for any future transactions or interactions with a bank. Which bank is the easiest to open an account in Trinidad and Tobago? Well, I can say that in First Citizens, you can schedule an appointment online at a branch of your choosing, and although yes, there are a lot of different documentation that we are mandated by to have prepared, we really pride ourselves in being the easiest in terms of account opening. Which is the best bank in Trinidad and Tobago, and why? Well, your answer is in the question. We are the only indigenous bank within Trinidad and Tobago, and First Citizens prides itself on being first in customer service, in our commitment to technology and driving a lot of the technology that will make your day-to-day simpler, easier. It really comes down to our tagline. We really focus on being simple, on being easy, and being fast. And that is First Citizens.
okay. So it seems like we're having a bit of a technical difficulty with Shaun returning. I am seeing your questions, Darian from Facebook, Alan from YouTube, and Dazzle from Instagram. From LinkedIn. We do want to answer these questions. Unfortunately, we're having some technical difficulties. So we will try to get them back, but unless if that doesn't happen, we will send you a direct message to answer your question. So stick around for this next video. I think we have. Oh, there we go. Shaun's back. Oh my gosh. Whew. Your timing is perfect because I was just about to go into another video.
My humble apologies. I'm not too sure what happened with the internet connection there.
Well, technology,
Luckily, I
we
was able
have
to.
no control over it. So, thank you so much for returning. We have a couple more minutes and we have a few questions. I know you were in
Sure.
mid thought. Unfortunately, you won't be able to finish it right now. So,
Um, if you ask me about the question, sure.
that's okay. That's okay. We'll get into the questions that have been asked so far. So Darian from Facebook wants to know, what about a secure loan to purchase a vehicle? Are there benefits to doing such?
Secure. Well, the vehicle is already security on the auto loan. If you're referring to a cash secured loan, um, the the only thing I can think about is with respect to the fact that the insurance will not necessarily need to be full comprehensive. If you're doing a cash secured facility where we holding the cash as security as opposed to the vehicle, um, the, ter- the term and the rate will be different from an auto loan, as opposed to if you're taking an auto loan, which the term of the facility would be a little longer as opposed to a cash secured facility, allowing you a more manageable installment. So that's one difference that you will see with a cash secured facility versus a loan that you're taking for an auto loan. For example, cash secured facilities or cash secured loans um, usually run for a maximum term of 6 years, as opposed to an auto loan where we can go up to 8 years. So um, that will allow for a more manageable or lower installment with a 6 year loan versus a 8 year loan. The other thing that you'll have to consider as well is that if you are using a cash secured loan to purchase a vehicle, that means for the term of the until that loan is paid off, that cash is going to be on hold. So if there's any emergency or anything that that may require cash immediately, that may be a challenge as well. So these are things that you will have to also consider as well.
Thank you for that responding. I hope we answered your question, Darian. If you have any further more questions, just head over to the comments. So we're going to ask Alan's question from YouTube. Uh, Wants to know if the down payment of say approximately $50,000 to $60,000, how does that translate into the installments for the mortgage and bank, as how it is explained is confusing.
Um, if you have a down payment of approximately 50 to 60,000, and how does that translate to installments for the mortgage and bank? As how it is? Okay, so to go into that, it will be if you're putting out a down payment of 50 to 60,000 on a loan, an auto loan in this case, your installment, well, of course, it will be in relation to the cost of the vehicle. So if I'm understanding your question correctly, in terms of guessing you're looking at how that will impact the installment. So obviously, the higher the down payment, the lower the installment is going to be. So for example, if you have a loan, a vehicle that is costing 250,000 versus and you're looking at maybe 100% financing versus putting out 50 or 60,000, your first and foremost your loan to value will be lower. And of course, if you're using the same frame of for the loan, which is 8 years, the installment will be lower. So 100% financing, let's say, for example, I don't have my calculator here with me, but let's say, for example, a loan for 250,000 may be about $3,400 a month, as opposed to if you're doing a loan for 200,000 because you've injected $50,000, the installment will be about 2,400 a month. So the higher the down payment, the lower the installment is going to be.
Okay. All right. So we have one final question from Dazzle on LinkedIn. Dazzle, the first part of your question we're not going to answer because that is, I mean, Sean's not here to represent all the banks. He is here on behalf of Scotiabank Trinidad Tobago. So Dazzle wants to know, can you explain the extra fees applied to an auto loan every 3 years of the loan's duration?
Yes, that is actually a very good question. Thank you for that. And I hope someone would have asked that question. So um, when vehicle is being held as security, as we mentioned before. There are the legal fees associated. There's a legal aspect of it, which we call the mortgage bill of sale. The execution of a mortgage bill of sale essentially is a legal document that is you will go to the attorneys, execute that document in the presence of the attorneys, where they will explain the contents of that. That is registered within registry, and essentially what that says is that you have taken a loan with Scotiabank, for example, to purchase this vehicle. Let's say Yaris, a Toyota Yaris, and you've agreed to pay over a period of 8 years, and this is the interest rate and so on. That mortgage bill of sale document is only valid um, for 3 years. So that means at every 3 years, that document has to be um, re-registered or updated, to simply put, updated, so that to ensure that all things are in place for that vehicle. And the cost of that is very minimal in terms of renewal, but because of the fact that the mortgage bill of sale document is only valid, has to be renewed every 3 years, that is what needs to be done. And and that cost is translated to the customer in terms of the legal aspect or the attorney fees for re-registering the bill of sale.
All right. So on that note, we want to close off. Sean, I want you to share what's the key financial advice you would give to someone who is currently searching for, um, you know, a better way of life, because that's what an auto loan is, increase the level of your life and where you want to go. So what's your number one piece of advice would you give to someone?
The advice I would give to customers or for those who are looking to purchase a vehicle is to first understand where you are in terms of your finances. That is a key element. The objective is to be able to afford the vehicle that you're looking for, afford the vehicle that you would like to, purchase, whether it's a Toyota, Nissan, whatever, it doesn't matter. But understand where you are financially. Know what your income is, know what your existing liabilities are in terms of loans, if you have credit cards and so on, as well as what is going to take for you to live comfortably. Because at the end of the day, what you want to be able to do is to comfortably manage your expenses, your financial expenses, but at the same point in time, be able to manage your personal expenses in terms of your day-to-day living, your um, household bills, groceries, and so on, because you don't want to be in a situation where you are looking to purchase a vehicle. It may be out of your range. It may be out of your range, but based on from a mathematical sense, you qualify for it. But at the end of the day, it's going to put a bit of stress or struggle on your personal side in terms of your day-to-day personal family expenses. So you want to look at all of those things properly to make sure that it balances well. You look at the vehicle, that the type of vehicle, does it fit into terms of what it is that you need, or is it that you're looking to make a purchase because the vehicle looking pretty, it looks nice based on the color, and you just want it, which is fine. But in all instances, make sure that you look at your finances, look at your income, look at your existing liabilities, and use that information to make an informed decision. So at the end of the day, you can be
Thank
able
you
to
so
comfortably
much for
manage
that,
both.
Sean. All
No
right.
problem
And
at
on
all.
that note, Sean, thank you so much again for joining us today and sharing insight into what you should know about auto loans. Sign up in the comments to be notified about our next live show, because all the links are there on the different platforms. As always, be sure to like and follow our page across social media so you don't miss a single live show. Thank you so much for joining us again. Bye.
Yeah. Take care.